Good morning, this is DealBook for Tuesday, August 4th, 2026. I'm Andrew Ross Sorkin, and I'm speaking to you today from Aspen, Colorado, where the Aspen Economic Strategy Group's annual meeting is underway. It's a remarkable gathering, 2 days of conversation among some of the most powerful economic policymakers of the last 2 decades. In the room, Jay Powell, the former Fed chair, 3 former Treasury secretaries Hank Paulson, Tim Geithner, and Janet Yellen, and Neil Kashkari, the Minneapolis Fed president who recently made headlines by dissenting against Kevin Warsh. The agenda is heavy: the trajectory of Fed policy, the simmering tensions around the Strait of Hormuz, whether the AI boom is drifting into bubble territory and what that means for jobs, and the growing national debt. I'll have much more from Aspen tomorrow, but let's start with what's moving markets right now. The bull market rally has kicked into another gear, and the fuel is corporate profits. S&P 500 futures are edging higher this morning, approaching yet another record. That's happening despite a wall of noise, a precarious US-Iran ceasefire that's whipsawing oil markets, growing odds of a Fed interest rate increase, and President Trump's renewed trade war. But the numbers are undeniable. 86% of the S&P 500 companies that have reported this earnings season have beaten analysts' earnings per share forecasts as of Friday's close, according to FactSet. That's not just good, it's historic. Shares in Palantir, Snap, and ON Semiconductor are all soaring in pre-market trading after impressive results yesterday. Robust consumer and business spending, and companies' pricing power, have padded bottom lines across the board. Alex Karp, Palantir's CEO, described the sales growth as otherworldly, his word, and the company lifted its full-year outlook. Up next, SpaceX delivers its first quarterly results after the closing bell today. Jeff Buckbinder, chief equity strategist at LPL Financial, wrote to investors yesterday, "Expect earnings to be the primary driver of stock gains this year." LPL hasn't raised its year-end S&P 500 target, but analysts at Goldman Sachs, JP Morgan Chase, and Citigroup have. And worries about massive AI spending aren't dampening the mood. The hyperscalers have rallied in recent days, Amazon surpassing $3 trillion in market value. Meta, which saw its huge capital expenditures weigh on its stock, is on a 3-day run, snapping its worst-ever losing streak. Helping matters, this bull market rally is no longer dominated by AI. The equal-weighted S&P 500, a broader measure of the benchmark index, is at a record high. Breadth is healthy. But what could go wrong? Plenty. Volatile oil prices could batter stocks and bonds. The yield on the 10-year U.S. Treasury note traded at 4.694% this morning, up from 3.95% on the eve of the Iran war in late February. President Trump called his push for peace talks a last chance for Tehran. And Iran and Oman appear to be near an arrangement to reopen the Strait of Hormuz, but transit costs are now likely to exceed pre-war levels. Record government borrowing is juicing the market rally, but borrowing costs are climbing, potentially squeezing the most highly leveraged investors. And watch the yen. The joint intervention by Tokyo and Washington bolstered the battered currency yesterday, but the yen is dipping again today as concerns grow that the move won't be enough. Some market watchers see another risk: intervention could undermine the popular carry trade, in which investors borrow cheap yen and reinvest in riskier assets like emerging market currencies and tech stocks. Investors could rethink that trade now that Tokyo and Washington want to see a stronger yen. Let's dig into a few of those pressure points. On the Iran-Oman front, David Sanger, Farnaz Fasihai, and Eric Schmidt report that the emerging accord would address President Trump's most urgent political problem by allowing ships to move again, but it would give Iran strategic leverage it did not have before the war. As described by officials familiar with the accord, vessels heading into the Persian Gulf will transit a channel controlled by Iran, close to its coast. Ships leaving the Gulf will travel on a channel near Oman. Iran essentially ratifies its control over what, before the war, was an open, international waterway. That's a significant geopolitical shift. On government borrowing costs, Joe Rennison reports that long-term yields shot higher Wednesday in a sign that investors doubt whether Kevin Warsh, the new Fed chairman, will keep inflation contained. The 30-year Treasury yield rose 0.11 percentage points to 5.22%, its largest one-day increase in more than a year, and its highest level since 2007. The 10-year yield, arguably the most important benchmark for global borrowing costs, has moved in tandem. This has ramifications for companies, consumers, and the government alike. And on the yen, Alan Rappaport has a fascinating profile of Treasury Secretary Scott Bessent, who made $1 billion betting against the yen as the top investor for George Soros more than a decade ago. Now he's using the might of the US economy to prop up the Japanese currency. But this time, he's doing so to help ensure Washington's borrowing costs don't creep even higher and to support a faltering American ally in China's backyard. The coordinated effort late last week was the second time in the last year that Bessent returned to his hedge fund roots to make a high-stakes currency play. The question is whether it holds. Now, to what's happening in Washington today. Tech giants are reportedly meeting with the Trump administration to discuss artificial intelligence safety. Anthropic, Google, and OpenAI are among those expected to participate, according to Bloomberg, as businesses and policymakers are on edge over reports of AI models going rogue and hacking other companies. The administration also says it has devised a voluntary framework for evaluating the safety of frontier models. At the same time, competition from cheaper Chinese models is intensifying. Jeanine Pirro's future is being closely watched after President Trump said yesterday that the U.S. Attorney for Washington, D.C., had choked in dismissing his claims that the damage to the Lincoln Memorial reflecting pool was done by vandals. The Wall Street Journal reports Trump has discussed ousting her, citing unnamed sources. But the Times reports her job is safe for now. 25 states are suing the administration over tariffs. The coalition, mainly blue states including California and New York, argues the administration acted illegally in imposing new duties under Section 301 of a 1974 trade law. While the Supreme Court struck down earlier tariffs, the so-called 301 levies are thought to be on safer legal ground. Anna Swanson reports that since the court struck down Trump's global tariffs in February, the administration has been busily reconstructing them, exploring legal options to build back the tariff wall. Late Tuesday night, they unveiled part of Plan B, a tariff of 10 to 12.5% on 59 countries and the 27-member European Union, intended to pressure governments that the United States says use forced labor. Some say the focus on forced labor laws is merely a pretext for protectionism. Now, a deep dive into one of the most closely watched cap tables in the world, OpenAI. Investors have committed more than $180 billion to the company, expecting a hefty payoff when the AI startup goes public, possibly early next year, near a $1 trillion valuation. On March 31st, OpenAI announced it had raised a colossal $122 billion from investors including Amazon and Nvidia at an $852 billion post-money valuation. Who holds how much is closely held information, but our reporter Sri Muppadai obtained the company's capitalization table after its recent funding round, confirmed by two additional people with knowledge. Here's what the cap table tells us. OpenAI's founders and employees own the largest share. Those with vested shares hold Class A common stock equaling 48.93% of the company. That group also includes investors that participated in OpenAI's 10 employee tenders over the years, including Thrive Capital and SoftBank. One notable exception, Sam Altman, OpenAI CEO, famously doesn't have any equity in the company. Microsoft owns more than a quarter, and early backer, Microsoft has invested more than $13 billion since 2019. Investors from previous rounds own nearly 20%. Those hauls include the initial $194 million round in 2019 from backers including Khosla Ventures and LinkedIn co-founder Reid Hoffman, a $6.6 billion round led by Thrive Capital at a $157 billion post-money valuation, and a $41 billion round led by SoftBank in 2025 at a $301 billion valuation. Investors in the latest round own about 6% of the equity so far, because the money is being invested in installments. The first tranche brought in $47 billion, including $15 billion from Amazon and $10 billion each from Nvidia and SoftBank by April 1st. Amazon completed a second installment of $35 billion last week, while Nvidia and SoftBank each put in an additional $10 billion last month. Nvidia and SoftBank have each committed to invest another $10 billion by October 1st. OpenAI's non-profit arm owns a stake too. The OpenAI Foundation owns Class A common stock and additional shares from the 2019 round. It's not clear how much the foundation now owns. It was 26% last fall, before being diluted by the $122 billion round. Quote of the day comes from Nora Freeman Engstrom, a legal ethics professor at Stanford Law School, speaking to The Times about the aggressive defenses Uber has used in lawsuits over allegations of sexual assault by drivers. Uber's strategy recycles an old and ugly script: if a woman drank, if she rode alone, if it was late, if her memory is imperfect, then maybe she is to blame. Tony West, Uber's chief legal officer, said in a statement, defending the company in a lawsuit and treating survivors with humanity are not mutually exclusive. We must do both. Now, a story that feels like déjà vu for JP Morgan Chase. For FIFA's president, Gianni Infantino, the plan to spin off FIFA's commercial assets into a new entity selling a 20% stake has been a disaster. The now-abandoned deal, which would have valued the spin-off at $20 billion, has resulted in boycott threats and calls for Infantino's resignation. For JP Morgan, which worked with Infantino on the deal, the fiasco probably feels familiar. Tariq Panja, who has reported on FIFA and the business of sport for 2 decades, writes that in April 2021, JP Morgan found itself in the midst of a storm when a plan for a breakaway Super League featuring the richest soccer clubs folded in less than a week. Fans poured onto the streets in protest, governments joined the condemnation. JP Morgan had offered to provide the financial underpinning. Chastened, the bank issued an unusual apology, pledging to learn from how it had misjudged the effect the plan would have on the feverish world of global soccer. Even Jamie Dimon acknowledged the company had misunderstood the passions that would be aroused. This time around, JP Morgan's involvement was led by Mary Erdoes, head of the bank's Asset and Wealth Management division. Infantino worked with Josh Kushner, the venture capitalist and brother of Jared Kushner, on the plan. JP Morgan's role was to recruit investors to join the deal with Thrive Eternal, a new subsidiary of Josh Kushner's firm Thrive Capital. The depth of JP Morgan's involvement was underlined by its logo appearing on a 25-page FIFA sales deck that leaked to the news media. The bank had analyzed the reputational risks before going ahead. The deal proposed was for investors to own a slice of the new company like a professional sports team, hoping for valuation increase rather than regular dividends. Part of FIFA's pitch to its 211 member associations was to share profits back from the proposed new commercial entity, FIFA Forward Enterprise. Sri Mupadai obtained a copy of the slide deck. The growth in future distributions would come from increased revenue via broadcasting and sponsorships. Where FIFA got things wrong, the recurring mistake is to assume that fans are a captive audience, Ronan Ivane, executive director for Football Supporters Europe, told Panja. The Super League proved we are not. What's next? Lawyers for European soccer's governing body have demanded that FIFA retain all documentation related to the project, including any correspondence with JP Morgan. In other news, investors in AstraZeneca questioned the wisdom of a potential tie-up with Bristol-Myers Squibb. Its London-traded shares were down 9% yesterday. Base Power, a battery power company whose founders include Zach Dell, has raised $1 billion at a $13 billion valuation. And the Financial Times has a piece titled Inside Google's $200 billion Wall Street finance machine for Anthropic. On the policy front, the Senate overwhelmingly passed a bill to avert another government shutdown, but it's unclear whether the House will follow suit. Katie Edmondson reports the legislation would keep federal funding flowing at current levels through December 11 and bar the Trump administration from transferring funds to the Border Patrol, a provision Democrats insisted on. The 89-4 vote reflected enthusiasm in the Senate, but the House remains a question mark. The Treasury Department fined UBS $125 million for inadequate anti-money laundering controls 8 years after the Swiss bank was punished for a similar problem. And 2 fascinating reads to close. The Wall Street Journal profiles a high-powered real estate fund run by college students. And Troy Clausen reports on Gen Z's dating crisis in New York City, from $130 dinners to expensive cocktails and exorbitant movie tickets. A crushing economy is creating a fresh barrier to love. Hein Tatu, turning 27 soon, knows the Inquisition well. A simple catch-up call with his parents might turn into rapid-fire interrogation. You're almost 30. Why are you not dating? When are we going to have grandkids? He filled his free time in graduate school working, desperate for cash to afford groceries and housing. He spent $7,000 on legal help for an asylum application after arriving from Myanmar. The economics of romance, it turns out, are getting harder to pencil out. That's your DealBook briefing for August 4th. We'll be back tomorrow with more from Aspen. If you have thoughts or suggestions, email us at dealbook@newyorktimes.com. Follow us on Instagram at @NetDealBook. Have a good day.